Markets are down. Your portfolio is in red and WhatsApp groups are buzzing with doom. And you're wondering, should I just pull out before I lose everything? Before you do anything, take a breath. Because smart investors don't react, they reset. So hi, welcome to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. According to AMFI, January 2025 saw SIP discontinuations rise by 109% year on year. More SIPs were stopped than started. That's rare. Why? Many investors entered during the 2020 to 2021 bull run. They only saw green, they only saw growth. But when markets turned, fear took over and the discipline disappeared. But ask yourself, would you cancel your term insurance just because you didn't fall sick this year? Or would you break a fixed deposit yearly because the interest dipped? Then why stop your SIPs now when they are doing exactly what they are built for? SIPs are designed to help you buy more when markets fall. That's the point, that's the plan. Market corrections aren't black swans. They are more like monsoons, expected, even necessary. Indian markets fall by at least 10% almost every year. A 20% drop, that's a bear market. It happens every 3 to 5 years. So instead of asking, why is this happening? Ask, am I prepared for this? Just like a pilot expects turbulence, a smart investor knows corrections are part of the journey. And jumping ship mid-air, never a good idea. Yes, the nifty small cap 250 is down over 30%. Mid caps aren't far behind. It hurts, but let's zoom out. From April 2020 to December 2023, small caps rallied nearly 150%. That's a massive run, and such rallies often attract froth. Companies with no profits and big stories. This correction, it's a detox. If you're holding quality businesses, which is debt-free, strong ROEs and consistent performance, this is in the end. It's just a reset. And over 10 years, small and mid caps outperformed large caps, but with a bumpier ride. Volatility is the price you pay for potentially higher returns. And money isn't just money. It's your child's education, your dream vacation, your peace of mind. So when your portfolio bleeds red, it feels personal. But that's when emotional investing becomes dangerous. Research shows that the average investor underperforms the funds they invest in. Why? Because of emotional, poorly timed decisions. So instead of reacting, what if you responded? Review your asset allocation, check if your goals have changed, and talk to your financial planner. This isn't a time to panic, it's a time to plan. So let's take a look back. In 2008, the Sensex fell by 60%. In 2020, it dropped 38% in just 2 months. And in 2022, global tech stocks were hammered. What happened next? Markets recovered, portfolios bounced back, and long-term investors were rewarded. If you had invested 1 lakh in the Sensex in 2003, it would have grown to over 17 lakhs by 2023. So despite all the crashes, all the scams, all the slowdowns, because corrections are events, compounding is a process. So what should you do when markets fall? Here are 3 golden rules. Number 1, don't stop your SIPs. You're actually buying more units at lower NAVs. That's exactly what SIPs are designed for. Number 2, stick to your asset allocation. If equity has dropped below your ideal mix, then rebalance. Add more equity. And if you can't handle the volatility, maybe your allocation wasn't right to begin with. Number 3, do nothing if unsure. Sometimes doing nothing is smarter than doing the wrong thing. Rely on your plan, not your panic. So here's the truth. Not every stock deserves your loyalty. Corrections are like low tide. They reveal who's swimming naked. That means poor quality businesses, overhyped IPOs and speculative bets. They are the first to fall and the last to recover. So ask yourself, does this company have consistent cash flow? Is the management clean and trustworthy? Will this business still matter 10 years from now? If the answer is no, it's okay to cut your losses. losses. A correction is your chance to upgrade the quality of your portfolio. So what are our final thoughts from this video? Markets rise, markets fall. That's the cycle. But wealth is built not in the highs or lows, it's built in the discipline in between. The winners, they are not the ones with perfect timing, they are ones with consistent behavior. If you're feeling anxious, talk to a certified financial planner, someone who will guide you with data, not doom, with strategy, not stress. So remember, stay calm, stay invested, and stay smart. Do you need clarity on your investments? Then click the link in the description to book a free consultation with a certified financial planner today. And if this video helped you, like it, share it, and don't forget to subscribe our channel for more simple, actionable money insights. So until next time, thank you for watching.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.